This undictated special podcast is brought to you by Futuregrowth Asset Management. Andrew Canter is with us on the line from Cape Town. Andrew, thanks for agreeing to have a chat about a really thorny issue. Investors in banking shares are trying to work out what the regulators are going to do in reaction to the meltdown in 2007, 2008. Now, they have been sitting together. They have been making their plans. Is there much that's coming out that could affect investors and indeed banks themselves?
Yeah, Alec, so if you think about what happened in 2007-8, there was an assumption that governments would bail out banks. That allowed banks to borrow quite a lot of money with impunity, without a lot of oversight from either regulators or investors or credit ratings agents. And that led to a situation where they just took far too much risk, and ultimately when they failed hard and big. And eventually governments had to bail out the banks and the banking sector to enormous cost. I mean, we're talking about countries like Ireland and Spain that by bailing out their banking sector literally bankrupted the countries, and they had to go running to the IMF for their own bailouts. And so all global regulation of the banking sector, as we look forward from that, is about how do we get that risk, the risk of bank failures, off of the taxpayers' shoulders and onto the shoulders of the investors in banks, both the shareholders who buy the equity and the lenders who either make deposits in banks or buy bank bonds.
Have the Irish and Spanish, and it's nice that you bring those up, have they been the leaders in this whole process, given that they were the countries that got hardest hit by the old-style banking regulations?
Oh, no, this is global. I mean, we can say they got hit hardest because of the size of the banking sectors relative to their economies, but let us make no mistake. I mean, the political climate globally, and particularly in Europe and the U.S., has turned exceedingly toxic towards bailing out the banking sector, bailing out bank shareholders, bailing out the managers of banks who drove these buses off the cliffs. So it's not really the countries that took it the hardest. It is a definite global theme, and we're talking about under the G20 global regulatory framework for how banks are going to be supported or not supported.
I suppose from a South African perspective, there were no bailouts here. Yet South Africa is going to align itself with what happens internationally.
Well, South Africa has always had very good banking regulation anyway, and a background interventionist reserve bank, and I'm going back 25, 30 years now to say that. But while there were no bailouts in 2008 or 2009 in the crisis, we can't forget that in the history of South African banking, I mean, we made an anecdotal list a couple of years ago, and we were able to count up something like 20 bank failures in 20 years leading up to 2010. So it's not, I mean, you may remember the names, the Prima banks and the FBC Fidelities and the Islamic banks and blah, blah, blah. I could give you a whole list.
Sambo.
Banks do fail. And there's depositors have never lost money to my recollection, but I think in the future that is now an open question, is what will government do?
It is interesting because if you remember the A2 bank crisis here in South Africa, Sambo, one of those, and that was just 10 years ago. We also had BOE where the bank decided, or the Reserve Bank decided not to come in and support it. But stepping back again, internationally, there is a move towards making sure, or at least trying, to not have the situation where banks are too big to fail.
Well, that's right, and so let's cover what they're going to do and talk about too big to fail. So now as we get to the idea where governments in the future don't want to bail out individual banks, or if they can avoid it, the banking sector, then what they want to do is transfer that risk onto the funders of banks. As I said, the shareholders first, followed by the subordinated debt holders, followed by the institutional investors who hold bonds, and finally by depositors who hold bank accounts in those banks. So in determining how each of those parties bears risk or takes losses in a crisis of a bank, that's called a resolution regime. Horrible phrase, but it's a phrase that we're all going to have to get used to, because it goes to how you resolve the winding up of a bank or resolve a bank failure. Who's going to take it on the chin? Who's going to get their money back and paid out in full? And so there's quite a lot of work going into that as to how that resolution regime for bank failures will work. But what I can tell you is right now, as we sit, it's unclear. It's unclear who gets paid first. It's unclear the differentiation, if there is any, between depositors and institutional funders of banks.
And it's interesting because I suppose there is a resolution regime in place already with companies that go bankrupt.
Well, that's exactly right. And business rescue, so that's exactly what we're talking about now. Business rescue is the resolution regime for companies that go bankrupt. And if you can't save them by business rescue practices, that is keeping them alive to see if you can restructure their businesses, then eventually they go into liquidation, and there's an orderly process, and there's clear legal definitions of who gets paid first and in what order, and by how much. Whereas with the banking sector, because these resolution regimes are not yet written, it isn't clear. I mean, there are things out there that are being talked about where you could force a bondholder of a bank, and I mean force the government, the liquidator, in effect the Reserve Bank, it would be the regulator at play here, could actually just say, okay, well, the bank's failing, the equity capital has been wiped out, so I'm sorry, Mr. Bondholder, you are now being converted from debt into equity. Or perhaps, you're supposed to get paid in 2 weeks' time, but, I've changed my mind and I'm going to now you'll be paid in 3 or 4 years' time if the bank survives. Or perhaps you're owed a million rand. By the way, I'm going to cut the face value of that to 500,000 rand. You're just supposed to take the lumps on that. So that is what could actually happen. It has echoes of the business rescue practitioner's role, but I think with a bigger force and with less clarity about what where the lines are.
It's not entirely theoretical if you think about the travails of a company like Able. So far, the equity shareholders have been happy to pump money in. The bondholders, I suppose, have had a bit of a haircut on the valuations. But if Able, and this is highly theoretical, but if Able were to go belly up, would we know what to do?
So Able's a current case, and I don't think it's a good example to use, because interestingly, Able has never been a deposit-taking institution. It's funded themselves in the institutional market, and I think the more interesting question about a bank failure is how do you deal with the difference between depositors, that is the man in the street, you and I with our personal bank accounts or our small business accounts from which we pay payrolls, versus institutional investors like pension funds and insurance funds, which is in the hundreds of millions of rands of deposits at banks. And that is probably the thornier issue, because it brings in questions of whether you introduce a deposit insurance scheme, for example.
And if there were to, again, very theoretical, if there were to be an Able type situation in a Capitec, maybe that would give you a better example. If there is no deposit insurance, as is the situation in South Africa at the moment, then depositors, what would happen to them?
Well, again, we don't know, because the resolution regime isn't written. But so globally, one of the pushes from the G20 and other governments, and they've already got this in many countries, is what's called deposit insurance. And here's an insurance scheme where basically banks pay a small fee on all the deposits they take, which basically, if a bank fails, the deposit insurance pays out those depositors up to a fixed amount. So I think in the U.S., if I recall, it's $40,000 per account as a cap on what you get paid out rand, or dollar for dollar. And in South Africa, maybe they put a cap on it of 100,000 rands per bank account. What that would allow is, if a bank fails, closes doors. Well, first, it prevents that happening, because it keeps consumers from causing a run in the bank and literally queuing outside the bank to get the money out, because they know that they're insured up to a number. But also, if the bank were to close doors, and people would still be able to access the money, because the deposit insurance would kick in, and they'd automatically still be able to make payroll, pay the utilities. But again, that's only going to cover depositors up to a fixed amount. Above that, then you start getting into these questions of bail-ins, of whether your debt converts to equity, whether you take haircuts. So in a Capitec or any one of the big five banks that take deposits, there would be questions about how to treat depositors versus institutional investors. Again, Able doesn't have many depositors, so it doesn't really apply to them.
But it's amazing. These are really thorny questions, which have they never been addressed in the past?
So it's interesting, because they should have been, and the truth is, this assumption, this ongoing assumption that we've had for quite a long time, that the government will ultimately, as a backstop to prevent a banking crisis or a bank failure, keep depositors from losing money, has basically meant there's a lot of unanswered questions, and that's not really unusual, because frankly, I'm pretty sure that nobody really understood, or even perhaps still doesn't understand, what's going on the financial statements and the operations of banks. There's so many risks and so many overlapping derivative structures and operations and what have you, that I'm not even sure bank managers themselves know everything that's going on in the balance sheet. So they're almost unanalyzable. So the fact that we just have faith that the Reserve Bank or whichever central bank was going to keep the banks alive, and people operated on faith. I think as we go forward, it's going to have a much more onerous obligation on investors to do analysis of these companies. It's going to more and equally on ratings agents, not just to trust management so much, but to actually get in there and do better ratio analysis perhaps and get more disclosures of risks. And I think people have to be more attuned to the potential risks of bank failures. We're really envisioning a case of governments avoiding bailing out banks.
And if the regulations are harsher, then presumably the bank profitability will also be affected.
Absolutely. So if we think about what led to the financial crisis, we had banks that had implicit government support. They were able to borrow a lot of cheap capital and achieve quite a lot of gearing with that. So maybe up to 45 times gearing on equity. So you had managers who were incentivized to use all of that gearing to take risks. And ultimately a lack of oversight from investors, regulators, and ratings agents, it all led to chaos and a disaster. So going forward, we're going to fix all of those things. We're going to have less gearing because there's going to be higher capital requirements. There's going to be more transparency about what the risks are, and more oversight. Investors are going to price higher for the risks they take. All of that should reduce bank profitability.
Yes, gearing does have a direct impact. Would you then look at banks differently as an investment prospect into the future?
Well, so remember, Futuregrowth is principally a lender into banks, not a shareholder. So from our point of view, yes, we will look at banks differently. We're going to look very closely at how the resolution regime comes to fruition and where our risks lie, and pay a lot more attention, I guess, to the likelihood of any individual bank actually getting into trouble. We're going to assess management probably more harshly. We're going to assess their risk management tools with a keener eye, because when banks fail, we will be forced to bail in. Our investors will be forced to convert to equity or take haircuts or take extended terms of repayment in a bank failure.
So presumably you're going to want to have that compensated for by a higher return, higher interest rate on the money you lend to banks.
Yeah, that's probably true. We will ultimately, once you measure up all those risks, you'll end up charging more for it. I mean, and that said, and all of that being said, I don't think what's going on is wrong. I think the fact is we saw what wrong is. We saw 2008-9, where all of this led to a complete near collapse of the global financial and economic system, which had to be supported by governments. That was patently unfair. So more capital requirements, better regulation and oversight. By the way, another key tenet is matching assets and liabilities. If a bank is making 15-year loans to people it lends money to, but it's funding that with 91-day deposits, well, that's a recipe for disaster, because people just pull money out quickly and leave you with a very illiquid bank. So that's being fixed as well through new regulation that forces banks to match the term to maturity of the assets and liabilities. That's a good thing. That is good business. So basically, I don't think there's anything I've heard in the regulatory framework being discussed that's patently wrong or stupid or incorrect. It should impact how banks operate. It should impact their gearing and their returns on equity. It should impact their cost of funding from institutions and even from depositors. So be it. That doesn't mean they'll be unprofitable or bad businesses. It just means you can have a reset.
Probably also means that they're not going to be making quite the profits that they might have made in their heydays. That's Andrew Canter, who's with Futuregrowth, and this undictated special podcast was brought to you by Futuregrowth Asset Management.